In this video, I'm going over my top 3 recovery stocks to buy right now for massive growth. I'll show you some of the key reasons why I'm choosing to invest in these stocks, as well as why these stocks will do well over the short term and also over the long term. And stick around till the end of the video so you don't miss out on any of these 3 stocks. Hi, I'm Jeremy Zargami and welcome to my channel. Today, I'm going to show you the top recovery stocks that I'm investing in right now. If you haven't already, click that like button, because the way the YouTube algorithm works, if you don't hit that like button, YouTube will show this video to less people. So to help out the channel and to help more people see this great content, hit that like button down below. And if you're a beginner investor, don't forget to subscribe. This channel is all about helping out new investors and guiding them along on their journey of growing their wealth. So be sure to subscribe and hit that notification bell so you can see every time I post a new video. I post a new video every Monday at noon. Now let's get into it. The stock market has taken a major hit in the last month. Many tech stocks in particular have been hit the hardest. For example, Tesla is down 32% in the last month. Many people are selling out of their tech stock positions and going into recovery stocks. This is mainly due to people anticipating the reopening of the economy, and they're trying to capture gains in stocks that aren't as overvalued as tech stocks are right now. These stocks include airlines, theme parks, hotels, shops, and cruise lines. I believe the stocks on this list will see gains both in the short term and the long term. The first stock on my list is Southwest Airlines. Southwest has been hit hard in the last year. Their stock dropped nearly 60% in March of 2020, but Southwest has been extremely savvy with their budget, and as a result, they haven't needed to lay off any of their workers, while their rivals American Airlines and United Airlines have furloughed over 32,000 employees. At the time of this recording, Southwest is trading for $57.10 per share. They have a 52-week high of $59.84 per share and a 52-week low of $22.47 per share. Analysts have Southwest at a 70% buy rating. Southwest bulls say Southwest operates a leisure-focused low-cost carrier, which is well-positioned for a leisure-led post-pandemic recovery in aviation. Southwest has generally been able to achieve low-cost carrier unit expenses and passenger yields close to legacy carrier levels. Southwest's focus on providing low fares could allow it to make inroads with business travel in the current recessionary environment. Morningstar has Southwest at a fair value rating of $47 per share, so it's slightly overvalued right now, but it's not too far over the fair value price, so I think it's still a good time to buy in. Their economic moat is none, their uncertainty is very high, and their stewardship is exemplary. Southwest's focus on domestic leisure travel should allow it to thrive in a leisure-led recovery. The next stock on my list is Starbucks. Starbucks stock dropped nearly 40% last March. As many people's commute to work stopped, so did their Starbucks orders. They saw a dramatic drop in their customer traffic, which caused a 38% revenue decline. But in the same time frame, Starbucks saw their average price per order raised by 25%. This shows that the decline in revenue was created by the decline in consumer traffic. This is an optimistic sign for when things return to normal. Starbucks also managed to increase their dividend by 14% year over year. This shows the confidence that Starbucks has that they won't be down for long. During the third quarter of last year, Starbucks opened 130 new stores worldwide. The fact that they're still expanding is a very bullish sign. At a time when many companies are downsizing or laying off a ton of workers, Starbucks has adapted really well during the pandemic. They launched curbside pickup that focuses on remote ordering, contactless delivery, and physical distancing. They're planning to lean heavily on their mobile app and digital orders to increase sales growth. This will not only increase the customer-friendly convenience of the brand, but also reduces the cost of order taking and customer acquisition. At the time of this recording, Starbucks is trading for $105.42 per share. They have a 52-week high of $110.47 per share and a 52-week low of $50.02 per share. They have a dividend yield of 1.62% and plan on increasing it by double-digit percentages year over year. Analysts have Starbucks at a 55% buy rating. The Starbucks bulls say Starbucks is adjusting to evolving consumer behaviors through a brand that transcends channels as well as digital flywheels, including mobile order and pay, social media, delivery partnerships, and loyalty program improvements. Beverage and food innovations and upscale store redesigns can improve the Starbucks customer experience, unlock new day parts, and enhance unit level productivity metrics. Despite its ambitious growth aspirations, we forecast Starbucks will eventually reach a 55% to 60% dividend payout ratio over the next decade, implying low to mid-teens average annual dividend growth. Morningstar has Starbucks at a fair value price of $100 per share. Their economic moat is wide, their uncertainty is medium, and their stewardship is exemplary. The third stock on my list is Disney. Disney saw a 40% drop in their stock price last March. They have been hit extremely hard in this last year. They had to shut down all of their theme parks and suspend Disney Cruise Line departures, resulting in thousands of workers being furloughed. Disney announced that they'll be getting rid of 32,000 theme park jobs. Although Walt Disney World, Shanghai Disneyland, and Hong Kong Disneyland are all open, Paris Disneyland and California's theme parks and resort hotel remain closed. Paris Disneyland is set to reopen on April 2nd, but there's still no reopen date for the California parks. But industry watchers expect all theme parks to be open by the summer. summer. This will be a huge plus for Disney. Speaking of plus for Disney, Disney Plus has been a huge success. As of January 2nd, there are 94.9 million Disney Plus subscribers. That's up from 73.7 million in early October and 60.5 million in early August. Including Disney Plus, Hotstar, Hulu, and ESPN Plus, the company's streaming service has more than 137 million subscribers. This year, Disney Plus will expand to Eastern Europe, South Korea, Hong Kong, and other markets. The company now expects to have 230 to 260 million Disney Plus subscribers by 2024, up from its prior estimate of 60 million to 90 million for the same time frame, with global subscriptions across all services reaching 300 to 350 million. Netflix, by comparison, has 195 million subscribers. At the time of this recording, Disney is trading for $194.77 per share. They have a 52-week high of $200.60 per share and a 52-week low of $79.07 per share. They have a small dividend yield of 0.46%, which I think they will increase year over year as they start to recover. Analysts have Disney at a 72% buy rating, and the Disney Bulls say the parks and resorts segment will rebound strongly from the pandemic as families still view the parks as a prime vacation destination. Although making movies is a hit or miss business, Disney's popular franchises and characters reduces volatility over time. Additionally, the firm's annual slate does not generally rely on one big picture, reducing the downside from a flop. Disney Plus has a long runway for growth, available in both the US and internationally. The firm's original series and the deep and constantly expanding library will drive the growth. Morningstar has Disney at a fair value price of $154 per share. So Disney might be slightly overvalued, but has a strong buy rating right now. So I think it still has a ton of upside potential. Their economic moat is wide, their uncertainty is high, and their stewardship is standard. What other recovery stocks are you looking into right now? Comment down below. If you like that video, I'm gonna put another video right here that I think you will like. So click on that video and I will see you in the next one.